what does everybody want? Everybody kind of just wants, I've got some money I need to park for the next 90 days. If I put it in the bank in Japan, I get 50 basis points or less. I put it in the bank in Switzerland, I get minus 50 basis points. If I put it in the bank in Europe, I get 200 basis points or less. If I put it in the bank in the US, I get 400 basis points or less. And so what I'd like to do is put it in some kind of structure where I'm going to get my money back in 9 months or 6 months or whatever. The principal's not going to move around, but I'm going to get 10%.
Right.
Everybody wants a bank account that pays 10% instead of 4% or 2% or 0%. And so I think the most interesting product that you can create, the most interesting digital credit product, is a treasury preferred credit instrument for corporate treasurers or for retirees, right? Just, you know, and how big is that market? It's like $30 trillion in the US. The opportunity with digital credit is you create a company, you hold Bitcoin, that's digital capital, you start to issue credit instruments on top of the capital, and you can decide how much risk do you want to strip away. Is it a BTC rating of 2, which is 2 times over collateralized, or is it 10? Right? 2 is less risk stripped away, 10 is more risk stripped away. Strip away the amount of risk you want, strip away the amount of volatility. The smaller the instrument compared to the overall collateral pool, the less the volatility. And then there are a lot of terms and conditions that you can put in the instrument that would constrain the volatility. So you decide how much volatility and risk you want to strip away. You decide how much yield you want to give it. You decide whether you want it to be in pounds or Canadian or euros or yen or whatever, you know. And then you distill out, you extrude the yield, and the pure, you know, boost over the risk-free rate, and you offer that to the marketplace. Pure kerosene, like I would say the other ones are kind of like gasoline or diesel or plastic or you know, or naphtha or something. There's a lot of other petrochemicals. You know, the entire petroleum industry is fascinating because out of a barrel of oil doesn't just come gasoline, diesel, and jet fuel. Also, you get acrylics, you get fibers, you get polyester, you get lycra, you know, you get PVC, you get the stuff that we make doors with it, we make walls with it, we make pipes with it, we wear it, we look through it, we burn it. Think about how profound it is. Like just around this room, if you glanced at the room, you'd probably find there's probably 100 or hundreds of petrochemical products in this room that have been created.
You mentioned how when Boeing issues debt, it's because they need the money. And when you do it, when MicroStrategy does it, you're issuing the debt because that's the product. And we think about, like, if I'm buying the debt of Boeing, then I'm trusting that their investment into their airline will have enough cash flow, maybe, to pay me in the future, versus I'm paying you, but you're buying the asset. So I'm not dependent on future cash flows because I know you have the asset and the debt is over collateralized.
Well, if you look at the credit markets, you've got corporate credit. That's basically a credit issued against future cash flows of a company. You've got investment grade corporate credit from Apple or Microsoft, and you've got distressed corporate credit from quasi-bankrupt companies. You've got junk from companies that can barely cover that cash, right? And so that's corporate credit. You've got mortgage-backed credit. It's when you're basically issuing credit back by mortgage payments of homeowners.
Yeah, we saw that play out in 2008.
Yeah, and you know, it's like the good news, bad news is if it yields a lot, they probably can't afford to pay it, and if it yields a little, you're not getting much yield, right? So either they're not going to default, but it doesn't pay you much, or it pays you a lot and they're probably going to default, and that's the great financial crisis, and we learned that. Well, then you've got municipal credit, you know, a little bit safer, but it pays nothing, right? Like almost no 2-3, very little yield in municipal credit backed by cities and projects. Like, you know, you've got bank credit. That is when you deposit $1 million in the bank account, you bought bank credit, you know. They're selling you bank credit and they're paying you the SOFR rate or the risk-free rate, et cetera. So there's that, but you know, it's pretty uncompelling in most countries. I mean, the best is the US and Switzerland and Japan. It's like nothing, right? It doesn't pay anything. Then you've got sovereign credit, fiat credit. You know, the government of the United States or the government of the UK issues its sovereign debt, and that's backed by the cash flows of the country. In theory, the taxing ability of the country, or just the ability of the country to print its own currency. And when the country has a collapsing currency, like Turkey, those interest rates have to be very high, but the country's currency is collapsing, and the issue is, what are you going to be able to buy with the currency or the interest you're going to get paid?
Right.
So really when's the last time in 100 years there's a new form of credit? Every one of those credit instruments, they've all been around for a while. You could argue that mortgage credit evolved into a higher form with Freddie Mac and Fannie Mae, right? What happened, the government started underwriting the credit risk of mortgages. That drove down the rates. That created systemic risk, right? So that changed a little bit, but the idea that a company's going to borrow money, or someone's going to mortgage their property, or a government's going to borrow money, or a city's going to borrow money, none of those are new ideas, right? I think you can trace them all back for hundreds, if not thousands of years. So the idea that, what was a quasi-stable idea, issue credit on gold, on a monetary asset, well, that, we saw that in the 17th century, the 18th century, the 19th century, even the 20th century. You could argue, British sovereign debt, French sovereign debt, they were all gold-backed credit instruments. And they were all backed by various amounts of gold, but it was almost never one-to-one. It was always like under collateralized, and eventually it probably got down to 5% collateralized in 1971. And that's the end of the gold-backed credit era, right?
Right.
And so now you have digital credit, you have digital gold, you have Bitcoin. Bitcoin is digital gold, digital capital. The killer use case of digital gold is issue digital credit instruments. And the aha moment is any company, any publicly traded company can create a digital credit instrument with any degree of yield, duration, delta, or risk. And to a certain degree with any amount of volatility that they want. Right? If you want extremely low volatility, you can't create a lot of it. Like if you have $100 billion of capital, can you create $100 billion of credit that's low volatility? No. But, the real interesting question for all of us in the industry is, can I create $10 billion of low volatility credit with $100 billion in capital?
Yeah.
Or do I need 100x? Can I only create I'm sure I can create $1 billion of very, very low volatility. At 100 times over collateralization, you'll certainly get it done. With 10x over collateralization, I think you'll probably also get it done. At what level, 5x, 3x, 2, at what level can you not? And of course, that's a function of the Bitcoin volatility too, because the less volatile Bitcoin gets, the easier it is to create these low volatility credit instruments.
Would it also depend on the creditworthiness, the trustworthiness of the company issuing it?
Yeah, I think it's a function of the issuer,
right? Their
reputation, their balance sheet, what's senior and junior the instrument. It's a function of the type of credit instrument. Is it a bond? Is it a preferred stock? The container it's in, the security design, the rails it's running on. Is it trading on the New York Stock Exchange, the NASDAQ, the Frankfurt Exchange, the Toronto Stock Exchange? How much liquidity? It's a function of the regulators, because in a more flexible regulatory environment, the issuer has more tools to strip the volatility. And in a more inflexible, traditional, primitive regulatory environment, the issuer doesn't have the tools. They can't legally take the action. And even the technology rails, for example, on the NASDAQ, you can't issue a preferred stock denominated in euros.
On the NASDAQ?
On the NASDAQ. Can't do it. So what if I wanted to pay a weekly dividend? In theory, it'd be less volatile, but technically, with the existing US banking system, it's not practical to snapshot the holders of record every week because there's like a 3-day delay. So it's very problematic to pay a daily dividend or a weekly dividend. Even monthly is about the quickest anybody's done. There are some exchanges where they're more inflexible on your ability to, say, do ATMs and issue securities at the market. There are other places. In Switzerland, they never issued there's no support for preferred stocks in the market. Okay, just the entire countries.
Right.
In
the UK, they're hardly used as well. Preference shares.
Well, there's an issue of whether they're used or whether it's impossible to do it too. And then of course, there's a question of, can the exchange you want to trade on support it? And the second question is, will the regulator allow you to issue it? And the third question is, will the investors in the country buy it? And the fourth question is, will the bankers that control those networks sell it?
Right.
And so you really have many, many layers of support that you need.
Yeah.
And I think over time, many of the better ideas will spread, but it's just like the spread of electricity or gasoline or crude oil or whatever. It's like they didn't all spread in the first year.
Right.
Take Robinhood. Robinhood is a way people buy a lot of securities today. They support common stocks, but they don't support preferreds. You can't buy Stretch, Strike, Strife, Stride on Robinhood. Why? You can't buy any preferred on Robinhood. Why? Because no one ever created one that anybody wanted to buy.
There was no market.
Because there's a market for garbage. Like, there's a market for 20th century traditional, defective, crippled credit instruments in the preferred market. Okay? They all pay 6%. They're under-collateralized. They're opaque. They're heterogeneous credit, right? And they're issued by any of 5,000 regional banks you've never heard of, or by 5,000 REITs you've never heard of. And they trade cheap. They're illiquid. The bid-ask spreads are wide. They have CUSIP numbers. There are no ATMs on them. No one's ever heard of them. Your private wealth, think about this, 100,000 private wealth advisors. They're, pulling up their Bloomberg and they're finding that 97th issue of some big bank preferred, and they're putting it in your retirement portfolio. And when it comes due or it gets called, they're rolling into something else, and they manage your money and they charge you an X% fee. And the person that actually owns that thing doesn't know what they own. They've got XXY QSIP 149223, and they couldn't even read the screen. And by the way, there is no quote on the screen. You have to buy a Bloomberg and pay $25,000 a year to get the quote. So yeah, there's that market. But the modern retail market, the digital market, is like 50 million people, want to be able to trade on Saturday afternoon. And so that is not a criticism, by the way, of Robinhood. That's an observation that you invent a new thing. The existing distribution infrastructure has never seen the new thing. There was no demand, so they didn't build out the rails to move the new thing.
Yep.
So there's been an inertia in the system. At the point that those things become screaming home runs and 27 million people ask for them, then, somebody upgrades the rails and then they start to distribute them. And so that's what's going on in the world right now.